Hello, welcome to my channel today. This is a King's Tutor. If it's the first time of joining us, thank you for clicking to this. Ensure you like, comment, share, and subscribe to my channel. Okay? And if you're a returning subscriber, thank you very much for your support. Now, I want to continue on our partnership series. We've seen diverse videos on partnership. In terms of its introduction, we have solved questions on it and also saw Goodwill as related to the partnership. Please, if you have not seen that video, ensure you watch it. I'll drop it in the description, or I will drop it up here, okay, before you watch this for better assimilation and understanding. Okay, now want to see revaluation account. Now, what do we mean by revaluation account, and why is revaluation account necessary? Now, revaluation account is adjusting the net book value of assets from its value it is before now to the current economic value of that asset. Okay, now we all know that the world or the economic activity is not in a static condition. That is, it does not stand still, it revolves and moves and changes. So when economic activities changes, definitely some assets, as it were, also what changes with them. Most time the asset might have higher value, and also some assets might have depreciated over time and reduced in value. So it is worthwhile for assets to be revalued. Okay, it is worthwhile for assets to be revalued to show their current value. Okay, now for instance, let's take for instance land. Now the land that is purchased at 10 years ago will not give you the same value in terms of when it is being sold out, will not get the same value with the land that is that same land 10 years ago. It's not the same value as at today. Okay, so the value might have increased over time. Okay, so it is pertinent to ensure that the revalue from the word it means that we are adjusting that asset to reflect the current state of the asset. Okay, so in terms of partnership, since it is business not owned by only an individual, it is owned by diverse persons that comes together in order to put their resources to establish such business venture. So it is pertinent for them to adjust this asset to ensure that it gives them the current state of that asset, so they know the current value and the current profit as regards that business. But most time they do not just wake up to revalue their asset. There are circumstances that makes them to revalue their asset, or there are circumstances that make them embark on revaluation of all items in a business, both their assets and their liabilities. Now, the circumstances that ensures that firm embark on revaluation, or partners embark on revaluation, is one, on admission of a new partner. On admission of a new partner. Now, when a new partner comes in, when a new partner is being admitted, definitely it is pertinent for the old partners to know the state of the assets and the liability, the current state, not the state of the asset when they started. Okay, the current state of the asset before the coming in of the new partner, so they can know what will be the profit or loss sharing ratio. They can also know the amount that is worthy enough for that incoming partner to bring in as a capital, because definitely there must be goodwill that have been generated in that business over time. So that incoming partner is coming to enjoy the dividends of that goodwill, the dividends of that good deeds of that business. Okay, so one of the reasons or circumstances that ensures that they embark on revaluation is when there's admission of a new partner. That is when a new partner is coming in to ensure that they know the state of that business when somebody is coming into that business. Okay, now another circumstances is when a partner retires. When a partner retires, it means that the partner will no longer be part of the partnership business. Definitely, in their agreement, they might have agreed that, okay, when someone have worked with us, about part of the partner have worked and stayed, definitely when he's no longer working, when he retires, some benefits might be accrued to him, some benefit might be given to him. So definitely it is pertinent for them to know the current state of the asset as at when a partner retire, so that they will know the amount of value that should be given to that partner. Okay, so that is one of the circumstances that calls for the revaluation of our business, of its account. So when the partner retires, definitely they want to know what is the current state of this of the assets and the liabilities there, so they know if that the current state of the goodwill, so they know what should be given to the partner as he retires. Okay, another reason is when there is changes in profit ratio. Now, when we started, I said one of the reasons for revaluation is because the economic activities and economic in general changes. It is not static. Okay, so when there is changes in profit ratio, now what does this insinuate? It insinuates that the previous profit ratio they might have been taken is no longer enough. The business might have grown to a state whereby they spend more time in that business to forsake other businesses. They spend more time in that business, they invest more in that business. So definitely their current profits they are taking might not be able to cover up for their bills. The current profit might not be good enough. So definitely they might embark on the act of changing the profit ratio. So when they want to change the profit ratio, they will have to do that to reflect the current state of that business. Okay, so in order to ensure that they do not suffer the business, they have to ensure they get the current state of that business to know the current state in terms of its assets. So when there is changes in the profit ratio, it also calls for revaluation. Okay, it also calls for revaluation. So these are some of the circumstances that might make the partners to revalue their account. The first one, when it's admission of a new partner. The second, when a partner retires. The third, the changes in the profit ratio. Okay, now in terms of the admission of a new partner, what are the reasons for admitting new partner? Why would a business that is doing well, why would they need new persons to come into the partnership business? That is, for instance, what are the reasons for admission of a new partner? Okay, now the first one, capital/fund need. Now, one of the reasons why a partnership business might admit more persons into that partnership is that they definitely will be in need of capital, or they need fund in order to get other branches of that business. Okay, in order to boost up their capital. So definitely, they know that it might not come from them, so they might want to admit a new partner that will bring in capital to boost that business. So that's one of the reasons for admission of a new partner. The second one is to replace a retired partner. To replace a retired partner. Another reason why they will admit a new partner is when a partner retires. For instance, we talk about it here. When a partner retires or when a partner dies, definitely it is pertinent to replace. Okay, and also when that partner is an active partner, for instance. So definitely it is important to replace that partner. So that's one of the reasons why they will have to admit a new partner. Okay, so another reasons why they will admit a new partner is to bring in goodwill. Okay, to bring in goodwill. Now we have talked about goodwill. We have seen a video on that, or a thorough video on that. If you have not seen that, I'll drop it up here so you watch it. Now, the goodwill sell is the advantage the firm have over its competitors. So definitely, one of the reasons why they will admit a new partner is to bring in goodwill into that business. Okay, so most time the situation that will empower them to recognize goodwill is when there's admission of a new partner. So they will have to take time to know how that business has been of importance to the outside world in order to recognize goodwill. Okay, so that is because the old partner will have to share from the goodwill when it is being retained in the business. Okay, we have talked about goodwill. Why the fourth one is to eliminate competition. To eliminate competition, okay? To eliminate rivalry. For instance, they have probably in their line of business, there's also another person that is also doing well. So one of the reasons why they have to admit that person to come to them is now to eliminate that rivalry between them, to eliminate that competition, okay? So that they can be the sole producer of that product. Okay, so that's one of the reasons for admitting new partner, to eliminate competition between other people. Okay, so these are some of the reasons for the admission of a new partner. Okay, so the revaluation account in itself, like we said before, it is pertinent in order to show the current state of the assets in that business. Now, when a revaluation account, most time in a business, they might call an expert to revalue the assets. So when there is revaluation of assets in that business, we have to open a revaluation account. Now we're going to see the bookkeeping entries where there's revaluation, what happens, and I'm going to show the pictorial representation of this. Okay, so as we'll see which account is supposed to be debited and which account is supposed to be credited, that is when there's revaluation. Now, what it means is that they brought out some assets in order to know the current state of that asset, not the old value, but the recent value. Okay, so there are some assets that will be lined up once you're given a question as regards that. After the additional information, there are some assets that will be lined up, and also liabilities. They will line it up and tell you these assets have been revalued. Okay, the revalued means that they are now showing you the current state of that asset. So what do we do in that situation when they show us the current state of assets? Two things must happen. It is either the assets have increased or it has decreased. Remember this. It is either the assets have increased or it has decreased. It cannot be the same, because it has been used over time. If it is, for instance, something like a plant and machinery, definitely a plant and machinery that have been used for, let's say, 5-10 years, cannot give the same value. Wear and tear must have taken place. So the value, when it is being revalued to show its current state, cannot be the same as at when it was purchased. Okay, so we have a depreciated value that has been attached to it. So definitely, once it is being revalued, two things must happen. It is either it has increased or it has decreased. So when this happens, we are going to open the revaluation account and also the asset account. And also not only asset, liabilities also. Most times the liabilities are also looked into. So if it is being revalued also, two things also happen. It is either the liabilities have increased or the liabilities have decreased. Okay, so when this happens, now let's see the bookkeeping entries. The bookkeeping entries. Number one, now to open a revaluation account, that is, for instance, if we said, given a question and they gave us some assets under the additional information, that this asset have been revalued. Now, what do we do? You have to open a revaluation account. Now, once I'm showing the entries here, I'll show the accounts here. Okay, so for instance, you open a revaluation account. Now, revaluation account will look thus. Now, also have the debit and the credit. Now, the debit will have to show decrease in value. Decrease in value of assets. While the credit will show increase in value of assets. Now, this is for assets, but for liabilities, increase in value for liabilities will be at the debit, while decrease in value for liability will be at the credit. Let me repeat. Decrease in value of assets will be here. You are seeing it. Increase in value of assets will be here. Now, in terms of liabilities, the opposite now will be the case. Decrease in the value of liability, decrease will be here. While increase in value of liabilities will be what? Here. While your corresponding entry will not be in the what? In their assets and liabilities, the individual account. Okay, so now what are we saying? We are saying that when there is revaluation, now they'll give you the current value of the asset in the additional information, and probably the former value would be in the balance sheet or the question given. Now you have to compare and contrast. You have to what? To compare and contrast. Now note, we are posting here the difference, not the value that was given in the additional information. It is what? The difference. You are going to get the difference. The current value of that asset or the liability and the old value, get the difference. But first, you have to know which is greater. For instance, if the one in the additional information, let's say a land and building, in the additional information is 100,000. Okay, that is say the revalue though. Why in the balance sheet, the previous value, now they say land and building is 50,000. When they say it's 50,000, if you see the revalued amount is higher than the what? The previous value of land and building. So what we are going to do is to post the difference, not to post 100,000 here as increase in value of assets. We are going to get the difference. So it is 100,000 minus 50. So you post, remember it's an increase now in the value of asset, because look at the old one, look at the revalued assets, 100,000. But what you post is the difference. So you get the difference, 100,000 minus 50. So you will now post in the increase in value of assets, land and building, 50,000. Now the 50,000 is not this one, no, it is the what? The difference. Okay, so now let me do it here. Now it means we are going to debit asset account and credit revaluation account. Now you do that when there's what? Increase in value of assets. Increase in value of assets. So when you open revaluation account for this purpose, you debit the asset account and you credit revaluation account when there's increase in value of asset. Like I said here, if there's increase in value of asset, you post the difference at the credit side. Look at it, credit. The corresponding entry will come to the asset account at the debit. So if we have a land and building account now, if I have land and building, see there's 50,000 here, we will now post it here as revaluation 50,000. Okay, so that will reflect it. Okay, so the next one we have, now this is when there's increase. The next one, you will debit revaluation account, you credit the asset account if there is decrease in value of assets. If there is decrease in value of what? Asset, you debit revaluation and you credit what? Asset account. Now for instance, if we take for instance, now we said, now if for instance, okay, let me use plant and machinery. The plant and machinery, the old value is 50,000, while we have the revalued value of the plant and machinery is 25,000. Now if you notice here, the old value is higher than this. It means there's a decrease. So once there's that decrease in value of asset, like I said, you don't post this, you get the what? The difference. Okay, now let me use something so that we don't get confused. Okay, let's say 40,000. So in this now, this is the old value, this is the revalued value of the asset. So it is 40,000. So it is a decrease because the old one is 50, the new is what? 40. So we have to post this transaction is saying debit revaluation account and credit asset account. So you come to the revaluation account, you're showing decrease in the value of what? Asset. So you post the difference. Like I said, don't forget, please don't get carried away to post this. The difference, 50 minus 40 is 10. So you now post plant and machinery, 10,000. Now you come here, plant and machinery in their individual account is debited. The corresponding entry comes here as revaluation, 10,000. So that will what? Reflect that. Okay. Now also you debit revaluation account and you credit liabilities account. I told you it is not only the asset that is being revalued. Now we'll do this when there's increase in liabilities. Okay. Now, for instance, if the liabilities increase, like for instance, creditors before now, they are owing them, let's say 10,000. So the recent creditors now is 50,000. Okay, this is an increase in the what? In the value of what? The liability. So when this happens, you debit it, the revaluation account. That's what it's stating. Debit revaluation account and you credit liability account when there's increase in the value of liability. So like we said, we'll get the difference. 50 minus 10 is 40. So we'll come here and you write creditors as 10,000. That's the difference. Sorry, 40,000. That's the difference between 50 and 10. Then you open a creditor account, which is a liability account. Now you post your corresponding entry, comes here as revaluation, 40,000. And this will show, remember creditors have a credit balance. So it has shown there. That is when there's increase in what? Liabilities. Okay. Now also, we said you debit liabilities account and you credit the revaluation account when there is decrease in liabilities. That is when the liabilities decrease, when the liabilities reduce. What you have to do is to credit the asset account and you debit the liabilities account. For instance, if we have a loan, let's say before now, the loan is 50,000 and now the loan is 20,000. Okay, so it's a decrease. So we'll just come here and write loan. The difference between 50 and 20 is 30,000. 30,000. Okay, and we'll come here and open a loan account. That is when you are being asked to show all the entries, even in the individual ledger. So corresponding entry will come here as revaluation, loan 30,000. Okay, so that is when you open a revaluation account to reflect all this. You debit this asset account and you credit revaluation account when there's increase in value of assets. You debit revaluation account, you credit asset account when there's decrease in value of asset. You debit revaluation account, you credit liability account when there's increase in liability, and you debit liability account and you credit revaluation account when there's decrease in liability. Okay, this is for asset and liability when there's increase and decrease. Okay, now the next situation also. The next situation also is when there's introduction of goodwill. That's 2. Now, when there's introduction of goodwill, like I said before, we have done goodwill account. I'm sure you watch that. Now, when they introduce goodwill, what they are saying is definitely over time the business have gained good reputation, okay, to the outside world. So in this situation now, when there's introduction of goodwill, now we have to debit the goodwill account and credit the revaluation account. Okay, when there's introduction of what goodwill, you debit the goodwill account and you credit the what the revaluation what account. Now what that means is that if they introduce goodwill and say goodwill is, let's say, 50,000. Okay, so what we have to do is to what credit the revaluation account with the amount of goodwill. Let's say goodwill is 50,000. Then you open a goodwill account. You debit it here as revaluation or opening balance before 50,000. Okay, so that will reflect when there's introduction of goodwill. Okay, because introducing goodwill is very important since you are revaluing the asset. Okay, so watch out for that. Okay, so the next one now is to check. Once you've done this, because you'll be given asset and liability, once you've reflected this, now we have to check if there is profit. Okay, if there is profit in this revaluation, if there is profit in the revaluation, that is, there is profit or profit exists when the credit side of the revaluation is greater than the debit side. The profit exists when the credit side of the revaluation is greater than this. Okay, because when there's increase in value of asset or the decrease in liability, remember this also decrease in liability is greater than the decrease in value of assets or increase in value of liability. So when this happens, it means there's what profit. And there's also loss when the reverse is the case. That is when here is greater than this. Okay, so in this situation now, the profit now will be posted to their old profit or loss sharing ratio between the former partners, not the new partner. Okay, not the ratio that involves the new partner. The ratio that involves the new partner is the new. We are going to post their profit or loss. We're going to share the profit among the old partner. You see, that was what we said, the essence of the introduction or the revaluation of what the asset. So in this situation, if now let's say transfer profit on revaluation. That's when there's profit on revaluation. Now what will happen? You have to debit the revaluation account and you credit the partner's capital account. Now where will you do this? With the old profit ratio. So how do you know when there's profit? Let's illustrate it using this, for instance. Now imagine here now we have 50 plus 30 plus 50, that is 130,000, and here we have 50,000. Okay, it means here is greater than this. Definitely there's profit. So it means here will be 130,000, and here is still 50,000. Now 130,000 minus 50,000 will give us 80,000. Will give us 80,000 as a profit. So they will now have to share the profit here. So it's a share of profit. So if it is two partner, let's say Ayo and Bola, if it is two partner and probably they share profit or loss in their old equally. So it will now be 1/2, that is half, times 80,000, because the profit is 80,000. So they will share between them. 1/2 times 8,000. So this one is 40. And 1/2 times 80,000. This is also what? 40,000. So everything here now will now give you 130,000. So that is why they say, look up, they said debit revaluation account. So this is the debit here. This is the profit. Okay, you share it here in their old profit ratio. Okay, while the corresponding entry now will now go to the capital account on the credit side. In the capital account, you will now post there where, for instance, if I would show the capital account, as a capital account, The capital accounts now we have in their columnar form, we have Ayo and Bola. So you now have there in the revaluation, you just have their share of profit. Say share of profit. For Ayo, it will now be 40,000. For Bola, it will now be 40,000. With that, you have done it. Okay, so that's when there's profit. Also, when there's loss, the transfer of loss or revaluation. When there's loss, what do you do now? You debit the capital account and you credit the revaluation account. Also, with what? The old profit ratio. With what? The old profit ratio. The same way, there is loss when here is greater than here. I've said it before. So you do it the same way in that profit or loss sharing ratio. You share it. It's on the credit side here. Corresponding entry will now come here at the debit side of the capital account. That is that. Okay. Now, lastly, now we said introduction of goodwill. Now, also, if they want to write off goodwill or when goodwill is not being retained. So what do we do when this happens? So if is the fourth, now the fifth. Now say if goodwill is to be written off, okay, what do? You debit the capital account and you credit the goodwill account. Now, how do you do this? Now, in the new profit ratio. Remember, we did this while we talked about the goodwill. Please watch that video. Or drop in the comment section, ask me of the video, and I'll show you, please. When goodwill is being written off, we said we debit what? The capital account. And we credit the goodwill account. In their new, now that new profit ratio is a ratio that involves the what? The new partner. The ratio they have that involve the new partner when they are writing it off. So these are the accounting entries that are needed. Please go through them. Okay, that's open a revaluation account. You do this. If goodwill is introduced, this. If there is profit, this, and if there is loss, and also when you're writing off goodwill. Now, the three accounts that is a necessity. Other ones they may ask you to prepare it depending on the question. But three accounts that is necessary is one, the revaluation account that you'll be asked to prepare in questions involving this. Two, the partner's capital account. You should do that. And three, the balance sheet after admission or after revaluation. Anyone. Okay, the balance sheet after the admission or after the revaluation. So these three accounts, they'll actually prepare it. The revaluation account, the partner's capital account, and the balance sheet after admission or revaluation. So that's the revaluation account. Now, please, if you have not liked this video, ensure you like it, please. And drop a comment in the comment section, please. So we're going to see a video. We're going to look at a question on how to solve a revaluation account, a practical question. Okay, so ensure you watch full to the end. Don't skip this video. Okay, ensure you watch full. Let's see a question regarding revaluation accounts now. Okay, now let's see this question on revaluation. Like we said, it said Sola and Ojo are in partnership sharing profits and losses equally. On 1st January 2021, they decided to admit Joke, who would be entitled to 1/4 of any future profit. The balance being shared equally between Sola and Ojo. Okay, he said they are both partners and they share profit and loss equally. Now, they said the financial position of the business before the admission of Joke was as follows. And this is the balance sheet before they admitted the new partner. They have the capital contributed by them, 102,590, that's equally. Creditors, 58,940. Freehold premises, 75,000. Fixtures and fittings, 26,000. Stock, 105,480. Debtors, 45,000. Cash in hand, 12,640. Now, additional information. Said A, it is agreed to value and retain goodwill at 30,000 naira. Okay. B, revalue the other assets as follows: freehold premises 100,000, fixtures and fittings 24,000, stock 103,000. Now they said provision for bad debt of 3,000 is to be made. D, capital is contributed by Sola and Ojo equally. And E, Joke is to bring 80,000 into the business as capital. Required, prepare the first one, revaluation account, II, partners capital account, and III, the balance sheet of the new partnership. Okay, now we are going to prepare the revaluation account. Now let's start with this. Now we have revaluation account. Okay, now remember in the credit side, we said credit side is increase in value of assets, and the debit side is decrease in value of assets. Okay, now in this now I want to start with the first one under additional information. They said it is agreed to value and retain goodwill at 30,000. Remember, we said if goodwill is retained or introduced into the business, we have to what? Credit the revaluation account and debit the what? Goodwill account. So right here, goodwill. How much is it here? 30,000. Okay. The next one said revalue the other asset as follows: freehold premises 100,000. Now we are going to check what is the value of the freehold premises before the revaluation. So freehold premises here is what? 75,000. Why the revalued amount is what? 100,000. It means it increased from 75 to what? 100,000. So it means there's an increase. So we'll post it on the what? Credit side. So we'll have freehold premises. Freehold premises. Remember, we said we are posting the difference. So 100,000 minus 75,000 will give us what? 25,000. That's freehold premises. The next one, fixtures and fittings, 24,000. Fixtures and fittings, 24,000. So we'll check the previous value, 26,000 here. Okay, and we have 24,000 here. So in this now, we are going to check 26,000 is greater than 24,000. It means it's decreased. It went from 26 to what? 24. It means there's a decrease. Okay, so we're going to post it here: fixtures and fittings. How much is it? 2,000. That's the difference. Okay, don't forget that. The next one, stock 103,000 is the revalued amount, while the previous stock is 105,480. Okay, so we are going to post the difference. It reduced. Look at the previous amount, but when they revalued it, it is now this. So we're going to have stock, because stock is an asset, so the value reduced. Okay, from this to what? To this. So 103,000, 105,480 minus 103,000 will give us 2,480. Okay, the next one is provision for bad debt of 3,000 is to be made. Now, provision for bad debt, provision is a money that is kept aside as against what? Bad debt. So they said the provision for bad debt of 3,000 is to be made. Provision is on what? Debtor. So it will reduce debtor, which is an asset. So the provision will come here. So have provision for bad debt 3,000. Okay, the next one. They say capital is contributed by Solano Joe equally. Now Joke is to bring 80,000 into the business as capital. So we are done with this. Now let's get the difference to know if there is profit or not. Remember, we'll say there's profit when the credit side is greater than the debit side, and there is loss when here is greater than this. Now from this now we have 55,000. It is obvious that there will be profit. So right here we have here total. So this is 55,000. So here now we have our share of profit. Now you're going to check what is their profit or loss, old profit or loss sharing ratio. Remember, it is old. Check here, you see, they say they share profit and loss equally. Solar and Ojo. So we are going to write here Solar and Ojo equally is 1/2. That's half. Okay. Now let's check the amount of profit. What is the amount of profit? So 55,000 minus 55,000 minus 2,000, 2,480, and 3,000 will give us 47,520. That's the profit. That's what they will share. 47,520. That is what they will share equally. Okay? So if you do that, you'll be having 23,760 and 23,760. So that when you add together, it is 47,520. So when you add all this, it gives us 55,000. Okay? So that is the share of profit in their what? Revaluation account. So with that now, they now have the word profit. So we are done with the revaluation account. Now, let's prepare the next one, the capital account. So the capital account will have to reflect the capital and what they have. Okay? So we'll have here the capital account. So the capital account okay, so this will be the particulars. This is Solar, Ojo, and Joke. This is particulars. This is Solar, Ojo, and what? Joke. Now from this now, we are going to post the capital account. The capital they brought Solar and Ojo equally. So this will be balance brought forward. 102,590. So we have 102,590. 102,590. So the next one is that of Joke. They say Joke brought in cash 80,000. So right here, cash 80,000. The next one, their share of profit. Remember, I said we are transferring the profit. We credit the capital account. So we'll have here share of profit. Share of profit, this is 23,760. 23,760. And this no share of profit. Okay? So that or we'll get the total. Total of this is 80,000. Now this 102,590 plus 23,760 will give us 126,350. This same thing as 126,350. Okay, so we now have a balance carried down here, so that it will balance automatically. 126,350, 126,350. So the last part is 80,000, 80,000. So that our total will now be the same as 126,350, 126,350, and 80,000. Okay, so that is the capital account. So the last part is to prepare the balance sheet of the new partnership. Now, how will the balance sheet look like after the admission of what? Joke. I said that. Now we'll have here the balance sheet. So we'll have the balance sheet. So we'll have the fixed asset. So we'll have the capital. So the capital is contributed by Solar, Ojo, and Joke. Okay. Now, Solar 126,350. Ojo 126,350. Joke 80,000. That's a capital. Okay. So if you add it up, 126,350 plus 80,000. This will give us 332,700. Okay, so in this now let's the fixed asset. Okay, now the fixed asset, remember we now have the fixed assets here, freehold premises. Now this is where you will now post the actual value here now, not the difference that was posted in the revaluation account. The actual value that was what revalued, the actual amount. So you check freehold premises 75,000. Was it revalued? Yes, 100,000. So we now have 100,000 here. So we have freehold premises 100,000. Okay, the next one is fixtures and fitting. We have 26,000 here, but fixture and fitting is 24,000. Okay, fixture and fitting is 24,000. So we have here the fixtures and fitting 24,000. The next one, we have stock 103. So we have here stock 103,000. Okay, now we'll check. Now the debtors is a current asset. So we'll come here, our current asset. So we have our debtors. Our debtors is how much? 45,000. It was not revalued. Okay, so write what was here. So now remember the same provision for bad debt is 3,000. So it will come here, the provision for bad debt. It will come to reduce the debtors figure. So 45,000 minus 3,000 will give us 42,000. Okay, why the last one here is the cash. So we'll have cash in hand. Now look up. The cash, Joker brought in cash 80,000. Okay, the cash that was brought to the business. So it's an asset to them. And also the previous cash you have is 12,640. So you are going to add them together. Okay, so it will now be 80,000 plus 12,640. So we have 80,000 plus 12,640 as 92,640. 92,640. So we'll add up 92,640. Now let's post at the left hand side here. Now what will be our liability? So we have our current liability. We have creditors. Okay, so we have here creditors. We have here creditors as 58,940. Okay, now if you remember, they said they introduced goodwill and it was retained 30,000. So goodwill is a fixed asset. Okay, so we're going to put it here. Now let's just remove so that we can have space. Okay, remove this current. So let's just put all this as assets. So we can have goodwill here as 30,000. Okay, as 30,000. So now let's add up. Now if we add up the left hand side, this will give us 332,700 plus 58,940. That's 391,640. Okay, so at the right hand side we have 100,000 plus 24,000 plus 103,000 plus 30,000 plus 42,000 plus 92,640. So it gives us the same thing as 391,640. So that is to show that our balance sheet balanced automatically. It shows that what we did was what correct. Okay, so that's how to show up the revaluation account. Now, please ensure you like this video. If you have not subscribed, please subscribe, because we are going to see more tough questions on revaluation account. There are situations whereby they will tell you the goodwill is not to be written off, and different scenario. So ensure you subscribe so that when I drop that video, you will see it. Okay, and also comment. Please ensure you comment. Tell me where you're watching it from. Okay, thank you very much. Now I want to recommend a video for you so that you can watch it now, and that is a partnership introduction video. Without that, you cannot understand it. Now you see this video here. Watch it now. Let's go. Watch it now. Thank you.